huge new malls packed with shoppers, new homes selling even before they're built, and millions of travelers driving demand for airplane seats and hotel rooms. China's emerging middle class is spending big on the good life, and that's helping its economy grow at nearly 7% a year. But many of these purchases are being made with borrowed money. And global ratings agency S&P says that's not sustainable.
The downgrade reflects our assessment that a prolonged period of strong credit growth has increased China's economic and financial risks.
The Chinese government has stepped up controls over some financial institutions like insurance companies. It hopes to rein in speculative investments and risky loans.
We are curbing insurance premiums from flowing into real estate. We strictly forbid insurance premiums from directly or indirectly investing in commercial housing.
But S&P's credit downgrade follows a similar move by Moody's in May. They're casting doubts over the effectiveness of China's financial reforms. And a slowdown in China could mean bad news for many other countries. China accounts for about 15% of global GDP, but it was responsible for a quarter of the world's economic growth last year. And Chinese companies are working on scores of infrastructure projects around the world, including the government's One Belt, One Road initiative. Now that the country's sovereign rating has been lowered, Chinese banks and companies will also see their creditworthiness slide. That could make it harder for them to borrow for projects inside China as well as in other parts of the world. Mobin Nasir, TRT World.
And Mobin's here with me now for more. Now, Mobin, foreigners own less than 4% of China's debt. So does this rating downgrade really matter that much?
Well, that's the argument that the Chinese made back in May when Moody's downgraded. They said this is not going to have a major impact on the economy. However, let's look at what they're trying to do here. Look, this debtapalooza, if you will, this started back after the financial crisis. Up until that time, China was getting a lot of demand for from export markets. When that demand wiped out is when the government started pumping in money. From $6 trillion in debt, we have come to $28 trillion in debt. And it could be argued that this was something the government had to do to maintain that 8% growth. But of course, just like the US is winding down its easing, the Chinese will also have to do that at some point. And at that point, they will need investors from the private sector with deep pockets to come in and to buy up those assets if they are not to crash. Now, what we've seen is that back in July, they've implemented a number of steps to make it easier for foreign companies and individuals to invest in their bond market. And the following month, in August, we saw almost a 50% jump in foreign holdings. So, of course, while right now there are not too many foreign investors buying into Chinese debt, that's not an ideal situation. So in that regard, I think it would be fairer to say that they are isolated, not insulated.
Yeah, interesting analysis there, Mobin. Very quickly, there are a lot of structural problems in China then, but when you combine everything that we've been talking about, slowing growth in China, you've got slowing growth in India, you've got, meanwhile, the buybacks, stagnating wages, you've got the asset buybacks in the West as well. Isn't all of this coming to a head? Are we heading to some sort of a new crisis?
Look, my favorite investor, Warren Buffett, has a very simple rule, right? He says you take the value of all equities and you compare it to the economy. Right now, if you look at the US economy, the value of the equities market is about 135% of the US economy. That's the highest it's ever been. Vanguard, one of the biggest funds in the world with more than $3 trillion in assets, they say the market has gone from overly pessimistic to overly optimistic. Surely there will be a correction at some point.
Danger signs there. We've got to get a final question in, Mobin. Meanwhile, China's central bank is telling its commercial banks not to deal with North Korea. What more do we know about all this?
So this is very interesting. The notification was sent early on Monday this week. And the banks have been instructed to not open new accounts for North Korean companies and to wind down loans to existing North Korean clients. But there's no mention of any sort of restrictions on existing clients accessing those their bank accounts or using other services such as letters of credit, etc., which are the actual means of facilitating trade. Most companies could, many companies could do without lending from the banks. They could source their money from different places, but what they really need the banks for is for their transactions. And so far, there's no word of any sort of limitations on that. Similarly, there's the issue of shell companies operating within China, which act as fronts for North Korean companies. And again, there's no bar on those.
Indeed. Mobin Nasir, thank you ever so much.